You don't wake up knowing markets, kid. Everybody starts brand new. First you learn what moves, what waits, and what risk can really do. No racing clocks, no magic tricks, no get rich overnight. Just learning how to place a trade and sleep cozy and tight. No shortcuts, no loud claims, just rules you understand. Know what you're risking, know your why. Keep a steady hand. One trade at a time, that's how it's done. Slow is smooth and smooth is smart. You learn before you earn, my friend. That's how confidence starts. This ain't a sprint, it's a longer game. So pull up a chair and plan. Welcome to Options for Beginners with Dan.
Dan, how the heck are you?
Troy, I am doing wonderful. It's good to see you. Good to see everybody. Welcome to the Beginner Show. We're excited to go over a few things. We'll continue. We're going to be doing the talking about the wheel, which is composed of two strategies, probably for the next week. And we'll get to that in a minute on cash secured puts. But I want to always keep it, as we talk about beginner stuff, a lot of it's repetition, going over it, examples, but it's also making it fun in that what's going on in the market, make it real. And right now, we don't want to lose an opportunity to discuss earnings type situations. And right now we have Google, G-O-O-G-L. They also have G-O-O-G. And I wanted to talk about that, just give you, even for a beginner, how do you participate? How do you participate in, okay, the Super Bowl's coming up. Is it this Friday, this Sunday, or next one, this Sunday? But how do you, if you're a beginner gambler, right? What a horrible thing to bring up on an option. If you're a beginner gambler, how do you participate in that? What do you do?
It's bet on the Patriots, but
yeah, bet.
it's an easy answer.
Yeah, what do you do? You bet on the Patriots.
Yeah.
Yeah, what's
That's neither here nor there. You're going to trigger me, Dan. As the case
sorry.
You're going to trigger.
Yeah, but I think that part of the thing is keep the dollars low. All right, number one. But number two, okay, what do you do? Well, we're going to talk about again, when you're playing earnings, a lot of people make it like, well, I just sell options or I do this, whatever. Remember, first thing I want to say, and then we'll look at the screen here. It's a binary event, right? When it's a binary event, anything can happen, even in your beloved stock, right? If you look at Microsoft, I think earnings came out recently, more than the expected move, or some of these will move more than the expected move. It's a binary event. One day, Super Bowl's binary event. Everybody says, I hear different people saying Seattle's the best team, but one guy said, is his name Colin Cowherd? Is that the guy's name? Yeah. He said, everybody says they're the best team, but my gut tells me Patriots, right? And but it's a binary event. If it was best of 7, like the NBA, it might be different. This is not best of 7. This is who's healthiest on game day and who has a good game, who has the momentum, blah, blah, blah. So let's look. We're going to look at Google from a beginner's perspective. And Troy, can you see this?
Yep.
And folks, you could, I guess, double left click or however you want to make it bigger. But here we are. And I say this right away. We were talking about this with students in our community. And I want to shout out right away because it saved me time looking. And he's much better at it than I. Meet in our community was looking at this for earnings play. And this, I just thought, oh, that's perfect for beginners. I'll look at a couple other ideas, but let me just make sure I can wheel around in here. 1 second. For whatever reason, Troy, I'm trying to move some of my things. And why is it not, you have the screen, you gave me the sharing, right? Yeah. All right. Because it's not, as I'm like trying to move the range or the date, it's not doing it. Should I try you taking it back and then
So,
do it again?
yeah, or just hit Google, like change the ticker real quick. Let's see what it does.
Oh, okay. I got you. No, I can't. The clicker won't. I
Okay.
can't do that. It's like my clicker. So I thought maybe if we, do you think if you took it and then let me share
Yeah.
again like we did earlier? I don't know if that'll work.
Yeah. So
All right.
we'll have technical difficulties while we do that. Do you want to talk about the wheel while I'm getting that set up for you?
Okay. So the wheel will be, I think I'll look at Microsoft, but again, the overview of the wheel, and we're going to talk about this over the next week. Here's the wheel, as you say from Chicago, the wheel, the Bears. You start with, it's this investing approach, again, long-term investing approach, but it's saying, hey, I'm going to start out selling puts in stocks I like. And, stocks at 100. I'm giving you an example. Stocks at 100, I'll sell a 90 put. This is pretty extreme. Sell a 90 put for $1 in stocks I like. So say, hey, it's for cash flow generation, right? I'm gonna bring cash flow. So stocks at 100, I sell a 90 put. If we finish above 90, I'm just getting a paycheck every month, right? In stocks I like. If we go lower, could be 5 to 10 to 15% lower, I'm obligating myself to buy the stock at the strike minus the premium. So if the stock's at 100, I sell the 90 put at $1. I'm obligating myself to buy more of this stock at 89. I loved it at 100. At 89, I'm drooling on myself, right? That's the idea. You start with the sell puts. But a lot of people, the tradition will be, if I get assigned, I'm thrilled to get assigned. And I'll be happy to buy the stock at $89, Dan. So if you follow the wheel to the right, if I get assigned on the short put once or twice a year, a stock I like gets hammered, I have a mechanism in place to buy stock 5 to 7% lower. Now I'm long stock. What do I do? Now, you could sell a call right against it, an out of the money call, or since if you got assigned on a put, that means the stock was going down. You could wait till it goes up a little bit, sell an out of the money call. That's called a covered right or buy right. And so you're selling an out of the money call. So you're still long deltas, long, you want the market to go up. And if the market goes up, right, and you don't do anything with the short call will at some point get assigned. It'll take out the long stock you have, and you're done. You've made your money on the trade, restart, right? You can wait till the stock backs off a little bit. You can jump in right away, but it's something that people have done for a long time. I contend there's a better way to skin the cat, a better way that's cheaper and a better yield. You say, Dan, why aren't more people doing it? You get used to it. You get used to the way you're doing it, right? Whether it's good or bad, people get used to stuff. Right now, are there reasons that people keep long stock? And you say, well, Dan, I've had the long stock for 232 years. I don't want to sell it and get taxed, blah, 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 blah. I'm talking about new stuff, right? A covered right, just give an example in Tesla, whatever you sell a put for, Tesla's $407. If you do a covered right, it's about $40,000. You do a cash secured put, 40,000 to make $3, $2, whatever it is. Well, what we're going to talk about over the next 2 weeks is the two main strategies in the wheel are short puts. They call them cash secured puts. That's a nice way of saying I've got enough money in the account to cover buying the stock if I get assigned. And then a buy right. Those are the two traditional ways. I think there's two better ways to skin the cat. And you can do them even in a small account. Instead of a cash secured put, what am I saying? Here's it in English and Somalian. Buy a stinking cheap put against it. Why wouldn't you? Right? Buy a 5 or 7 delta put, and we'll go over that. and you can reduce your capital from here to New Jersey, right? And we'll talk about your concerns in a little bit. So it's a put credit spread. What's an alternative to this thing called a buy right, buying stock, selling call? The alternative is just replacing the overly expensive long stock with some kind of long call. That's it, right? But Dan, I don't know all the minutia against it. We'll talk about it. As Joan Rivers says, we'll talk, right? We can work through that. But to me, it is a lot better way to skin the cat. And the main reason is, well, Dan, I don't understand it right away. Well, that's wonderful. So you've never done something, but you don't understand it right away. It's crazy. It's a crazy idea, right? So we'll work on that. But we're first going to take, if we can get the model working, if not, Troy does better on it than I do in easily. But we'll try to look at my example in Google.
Look at that right there.
Try to give it another shot here. Let's see.
Yeah.
Do you have me set? Let me see where I can hit the.
Let me do this real quick.
Yeah.
Share your screen again.
All right. The only buttons I see there are mute, disable camera, and settings. I don't see, like when I came into the live stream, it had that share.
Okay, I'm going to share my screen then.
All right, just do that, and we'll do that, and we'll work out my mechanicals.
Yep.
Mechanicals.
Okay.
So here we are, folks, and this is as I said, we'll go over a couple ideas, but the first one, which was perfect, I saw this. We were going over this in the morning in our community, and Amit, who is very, very good at a lot of the earnings stuff, suggested this, and I thought that's perfect.
Is it Google GOOGL?
Yes, so we're going to use GOOGL. Okay. And we'll set up the trade, and then I'll give you the big perspective. We're looking at Feb 6, the 347.50 call vertical. Feb 6, we're going to buy one call vertical debit spread, things we've been talking about in the beginner for a while. 347, 350. All right. And you say, yeah, so it's just a plain call vertical debit spread in a $333 stock. It's $75. So definitely the dollar amount jives well. So let's give a little bit of color on this. And again, this was discussed earlier in our community. So this is definitely other people, Amit and others, not myself. So I just want to, as they say in Option Omega, well, shout out. Yeah, I'm not used to, yeah, shout out to the smart people. All right. So some of the overall thinking was, okay, this is earnings. How do we look at earnings, Dan? And first thing I do is I look at, before we get the minutia, you look at a price chart. And, when you look at a price chart of Google, it's been going, it's been kind of slowly trending up, right? And it's in the AI realm now, right, Troy? It's in the AI realm. But for people who understand it much better than I do, they're saying, well, AI is different, or Google's different than the other companies in that, is this correct? They fund all this building up AI, they're funding it themselves, right? They're not going out and getting so they're seem like they're better suited. Plus, as in anything, Troy, if you're betting the upside, you do it because Warren Buffett, isn't this one of the ones?
When in doubt, yeah, that's right.
When in doubt, follow Warren. Now, with all that being said, folks, before you go and sell your used car or whatever it is and put it into Google, this is a speculative binary event, just like the Super Bowl. As much as you could say Seattle will win in a best of 7, but one game, it's a different ball game. And so here's the thing. So where do we start with this? How did we come up with this? First of all, you look at, well, what is an expected move here based on past earnings? Expected move is about $20, $21. Is there a way to come about this real quick? Troy, if we could we can maybe get rid of this for a second and just back up in the expected move. If we buy the at the money straddle, and again, Google's coming out earnings tonight. It'll hit the market in the morning tomorrow, which is Thursday, but they don't have tomorrow expert. They have Friday. So if you buy the at the money straddle, the cost is around how much, Troy? $21?
Yeah, $21.
All right, $21. You know what? Do the market makers know? If you look at what's the expected move, about $21. Would it be wise, Dan, to buy an at the money straddle? No. I'd rather you take a fork and stick yourself gently, maybe a plastic fork, in the eyeball, but have a pair of glasses on. This sounds horrible, Troy. But the point is, if Troy put this straddle on at expiration on Friday, you need this to move $21 to break even, right, Troy? Is the red is showing?
Yep.
Troy has got he moved the date all the way
at expiration. Yeah.
Yeah. So if you can think of a horrible move, it's like Evel Knievel going over the Grand Canyon. He needs, just to break even, he needs to go, 3,000 yards or whatever it is. But if he doesn't make it, he's toast. Right.
And the worst, I mean, it's even worse news because you have IV working against you, implied volatility with these earnings. And so, what's going to happen? Say you bought this and tomorrow, let's say 948, just an example.
Oh, yeah.
Vol's going to be about that. Right.
Well,
so
that's right.
You really need movement or else this thing's just going to get crushed immediately.
Well, I think Troy said the most important thing. Because there's an expected move in Google of about 20 points, which is the market maker move, they call it, you're paying, it's like you're paying the equivalent of, you're paying for Michael Jordan's last basketball game, right? You're paying through the nose. So could you make money on a long straddle once in a blue moon, right? If Google moves much more than the expected move, could you make money? Yeah, but again, there's other ways that you could skin the cat a lot better. So just giving you an idea where the expected move is. Now, they're saying we could be plus or minus that amount. But here's the other thing. The expected move is 21 point. Could we move 10 points? Yes. Could we move 7? So you start out this whole game with, well, what do you think? Do you think it's going to beat the expected move or not? It's a binary event. So I'm not saying the wrong thinking is, hey, where does Fibonacci tell me that Google's going over the next month? I don't care. Where's Google going to be next week? I don't care, right? We're talking a binary event. Do I think it's going to beat expectations? Then I want a little more speculative move. If I don't think it's going to beat expectations, I think it's going to move less than 20 points, maybe 10 points, maybe 7 points. I might consider a range-bound trade, an iron condor or a calendar or something like that, but it's used in a speculative way. Now, so here, I think it's best to do some kind of vertical debit spread where you're going for a home run, right? And so if we go back to the spec, the people I polled in our group and Amit and others, we're looking at the call side, right? Even though we've kind of trended up a little bit here, they're looking to do it on the call side. So it'd be about a $67 trade. And I want to see how you say, Dan, how did you pick the strikes? Well, part of it is the expected move is 20. With a vertical debit spread, what's our delta starting out, Troy, on the vertical debit spread?
About 4 delta.
Yeah. So you're leaning a little bit long delta. So you don't need to put the short strike right at the expected move, right? So if we're at 332-ish, 332 right now, almost 333, 20 points up would be 353. You could put the short strike a little bit before it or whatever. So like that's why we're selling the 350, buying the 347s. Could you sell to come a little closer the 345s and buy the 340s, a 5 wide? You could. That might be a few more cents, right, Troy?
Yeah.
So
Yeah,
here,
I mean,
it'd be, you to pay a little more because you're coming closer, right? It doesn't have to push as much. But we'll stick with the 347.50. And again, this is Friday expiration, so it's not over, right? Tomorrow morning. But if you look at Troy, walk us through this with the modeling. Maybe take us. The other great thing with a call vertical debit spread is we're buying an option, we're selling an option. So when volatility, drop the volatility, Troy. Like let's say tomorrow we go up to 3, we go up reasonable, not the expected move. We go up to 340, right? We go up to 340. The expected move is 21. We only go up 8 points, but take out the volatility quite a bit. And that might be, you could be down $29 on it. What did you take the vol from? What was it at?
102. So
and you know what? It might not come that much, but you know what? I don't think Troy's far off here. I mean, it could come out 40, 50 points, but even if we go to 340 tomorrow.
Yeah, you're not hurting. I mean, that's the thing is like, you're not hurting. And again, you didn't start out with a big debit anyway. And so
it's a cheap shot. Yeah,
it's a cheap shot. And that's the whole point is like versus that straddle. Well, now you're hurt on both sides because the vol got out and hurt in massive quantities. This is tiny,
Yeah, take us to expiration, Troy. So we'll just show them the expiration. If we get to our short strike, 340, 347.5 or higher, right? As Marlon Brando says, you could be a contender. We can make 253%, right? The $70 debit will grow, right? That's at expiration. Now, do you hold it that far? Sometimes people might have, let's say someone said, Dan, I like the trade. I'm willing to risk $150 if I lose everything. You can do 2. Dan, I'm willing to risk $300. All right, maybe you do 4. But again, I want to say this many times, binary event, right? This could easily go down. But here's the thing. If you think, well, Dan, and again, this is the thinking of it, I only think we'll move $5 or $6. Well, then you might be better off, like we were looking at, bring it closer, buy the 340s, sell the 345s. You said, let me come closer so we don't need as much of a move. I don't mind paying another $100. Now it's $185, but you only need us if we're, different, right, Troy?
That's right. And I mean, basically what you're paying more for a higher percentage chance of it hitting, so the return is going to be about the same. You just get a little bit of a kicker, the chances, but for this, like Dan was saying, like, half that, or I mean, more than half that. And, for the same shot, basically for less percentage chance, you pay 72, you could also get a higher percentage winner. So the question is, do you want the percentages on the front end or do you want the percentages on the back end? That's one way to look at it.
Yeah. And there's other things here. I'm already thinking broken winger, but you know what? I think we'll stop it at this in a second. It's a vertical debit spread, I think is a great tool for beginner traders. Here you're in a $332 stock. You're in the Super Bowl. We're sitting in the cheap seats, right? We're not in the booth with Travis and Swift, and we're trying to get them as sponsors of the show. We have not yet. I still don't understand this, Troy. I read this somewhere, and again, I should why I even looked at this, but it was looking at when Travis Kelce, I think it was last year, he got, or whenever they were in the Super Bowl, he got a suite for him and whatever her name is, Taylor Swift. He paid $3 million. He's not making, I mean, that's for a guy, he's not
for
making.
True love though, Dan.
That's true.
I mean, I'd pay top dollar to get you seats.
I love it.
True love. Yeah.
Troy, when you said the word true love, you know what that made me think of? Princess Bride.
Oh yeah.
Oh,
as you wish.
I still think the best scene in that movie. I just love it when I don't know what comedian was the preacher at the wedding.
Was that Billy Crystal?
No,
Billy Crystal played something else in that.
Yeah, and he was great. But the preacher, just how he did True Love, but they used True Love quite a bit in that. Anyways, but folks, this is, again, but here's the thing. You could say the nice thing with vertical, you can put an opinion. I think it's going down. You could do the put side. I think it's going up. I do the call side. I guess I don't want to get into this, but I guess technically, could you put a call vertical and a put vertical like a reverse iron condor? Yeah, but at least, today what we did is we talked about how do you make a decision? How do you think around earnings? And you don't start with, well, here's a chart. I think Google's going up. Wrong. Get out, right? No, this is a binary event. We don't care what Google's doing next week. We care from tonight to tomorrow morning. That's basically it. And maybe the next day or two, binary event, think accordingly. And you know how they do this weird stuff. Even yesterday with AMAT, am I right, Troy? AMD came out.
Yep.
And as usual, earnings came out better. Earnings came out really good, but the stock is getting hammered. Well, what does that mean? Because that makes you think this is rigged. No, it's all on expectations. If they thought earnings were going to be super and they come out only a little bit super, they're going to tank the stock, right? It's all on the expectations. We think earnings are going to be very, very good, right? Or the expectations are very, very good, and they only come out at one very, very good. Well, they're hammering the stock, right? So you have to, it's a different game. And I think the other thing is, if you do range-bound trades of $1,000, I think it's reasonable size to do a spec earnings trade for $70, right? 10 times less. So I think size is probably the best risk management tool ever invented, whoever invented size and the options. But anything what we'll do, folks, just because we've gone we want to take our time on this. I think we'll start the wheel stuff and cash secured puts on Friday. But I thought it would be interesting to at least talk about this, that, very under control. Now, let me just say one thing, Troy, last thing, and I want to see if you have any thoughts. In the South or a lot of places, they have these dollar stores, right? And so people go into dollar stores and they say, it's only $1, right? I'm going to buy it. Do you need it? No. Will you in 2 lifetimes, will you ever use half this stuff? No, but it's $1. And so should you do this because it's $73? No, on paper, right? Should you do this? No, you should do this if you think, you look at the trade and you see how far Google's, what the move is saying, what the trade is saying. And I agree with it, right? Because I'd rather lose nothing than $73, right? And so now you can paper trade it and everything. But again, I think that's the process. Do I think number one, do I think it's going to, what's the expected move? Do I think it's going to beat the expected move? No. If I don't think it's going to beat the expected move and I want to do a vertical one, let's say I want to do a bullish, bring in that short strike a little bit closer, like we showed here. But we put, right now, currently Google's at GOOGL at 333. We put the short strike at 350, which is about 17 points up. A little bit, we put the short strike a little bit less than the expected move, made it 2.5 points wide. Why 2.5 points wide? Because it's cheaper. Dan, could I make it 5 wide or 10 wide to make it a bigger landing area there? You could. It's a little more expensive.
Yeah.
I would recommend for a small account, do it 2.5 point wide, get used to it of a trade. You can do it paper at some point. If you're comfortable, you can do it live, but that's the way I think people should be trading vertical. And let me just say one last thing, whether you're beginner or advanced, I mean, there's other things you could do more advanced, but if you said to me, what are some of the most advanced people in your community or that I know in the retail sector use for earnings? Don't tell anybody, but it's vertical debit spreads, right? Because they're cheap and they're a great bang for the buck, right? Whereas, yeah, anyways, well, thank you, Troy, for any other.
No, I think that's great. I mean, again, the point is to say you can get as complicated as you want on earnings plays, but a lot of times, I mean, I think just keeping it simple is, take a shot. And especially if you're newer to options, it's pay $70. I mean, that's about as cheap as you're going to get on an option spread. And so,
it's not crazy. It's not like way out of there that you need some unbelievable, this is less than the expected move, right, on the upside.
Exactly.
And if you think it's going to move even less, stay the vertical, pay a little bit more, come a little bit closer, but use that expected move as kind of a guideline to put your short strike. And if you control your size, it can be a pleasant experience, right? If you use too big a size, you're like, oh, geez, I'll never do it again.
Enough to not care. Keep it small enough to not care.
Good. Great way to end the show. Folks, we'll see you on Friday. Thanks, Troy, for running the ship.
Thank you, Dan. We'll be back.